Hello, and welcome to another episode of Buyouts, Business, and Bourbon. I'm very excited about our guest today, Dan Campbell of Campbell Petrie. Dan is in the benefits consulting world. We'll hear a little bit about group health benefits, life insurance, dental, everything benefits for middle market and small companies. Dan's been around the space for a long time, so his expertise, I think, will be really enjoyed for this by our listeners. So we're really excited to talk a little bit about self-insurance and everything else. But before we get to the more serious topics, Dan, tell us a little bit about your journey there. I know some of the talents we'll address toward the end is your bourbon drinking and your golf, because Dan can hit a golf ball basically 300 yards. So I'm not sure if you'll be able to explain to us how you do that. Maybe for the listeners that want to hit the ball 300 yards, we could talk about that. But anyway, welcome, Dan.
Thanks, Jerry. Thanks for having me. I appreciate it.
Yes, so tell us a little bit about how you got to where you are today and, in this benefits consulting world. And I know you've kind of got into captive insurance and self-insurance for companies. So tell us a little bit about your journey to get there. I would love to hear that.
Yeah, sure. So coming out of college, I was a finance major. I went to Iona, played football there, and had some connections through that, and was hoping to. I think where I was headed in my mind was something down in the Wall Street perspective, whether it was a big financial bank or investment banking, something like that. And when I got out of school, it just, I didn't find anything really in that space. And my uncle had been working at Cigna Healthcare for a good amount of time. And he was able to get me an interview over there. Really didn't know anything about health insurance like most 22-year-old kids. You're sort of just on your parents' plan, and you know the brand names, the Blue Crosses and things like that. So you've heard of it, but you really don't know how the companies work. And I was in between that offer and that job, which was supporting the sales team over at Cigna, or going into I believe it was a credit analyst job at this company that sold carpeting to GM, was their big customer at the time. And it actually wasn't a great
Wow.
time for GM, so they were analyzing the debt there. But I don't know, I just saw myself more, joining a sales team versus crunching numbers all day. On, it's funny, I do spend a lot of time crunching numbers now, but it's for my customers, not so much on the financial side. But so I ended up taking a job at Cigna, and sort of learning the business there, and appreciate my uncle Matt over there who was able to get that going. He's actually still with Cigna, and I see him a lot around the industry, and of course as a family member. But he also got my couple of my other friends, and I got some interviews there. So we sort of pulled this little lineage through Cigna, through Middletown. There's probably about 8 or 9 people that track back to Matty, getting me that conversation started there. And I only spent a little bit of time there. When I was there, I was supporting guys like myself. So I was calling on brokers and consultants, and trying to get them to sell the Cigna product. And, I found out pretty quickly that it just wasn't for me to be on like the one product side of it, where it was sort of my product. I had to sell it. For me, it felt like I was, in cases, forcing a sale where it necessarily wasn't consultative. I was just, trying to sell on price, or, position Cigna to be the best in a competitive environment, where I felt like where I wanted to be was giving advice to people. And so Bruce Petrie, who, eventually became my business partner, had a partner retiring at Northwestern Mutual, and he was running the employee benefits department there. It was called Strategic Employee Benefit Services. And there was one of those offices, SEBS is what we called it. There was a SEBS office in pretty much every Northwestern Mutual office around the country. And we were an internal employee benefits operation for the financial advisors at Northwestern Mutual. So if they had opportunities in the employee benefits space, they would come to us, and we would work on those, and then, help out their business owner clients. And
Right.
so we worked in that environment for a long time, where, people were coming to us. And what I really liked about that role, and it was great for me, and even like young people, and, that come into this business, is I really had to do everything. So I was selling, I was servicing, I was doing claims management, working on enrollments, filling out enrollment forms for people, doing in-person meetings. So We were a smaller operation at the time, and really, you had to do everything. And
That's
I think it
probably
was
best way to learn the business, though, right?
it really was, and so it was like even down to like, processing commissions and things like that. And we had a small team, and it's obviously, grown since then. Oddly enough, it's actually the same company, that I worked for when I left, Bruce and I, and I'll get into that, how that all happened. But it was amazing though to learn the business from the ground up. And I started working with lots of very, very small businesses. And as I got I would say a better reputation within the office and more trust of the advisors. They were bringing me out on bigger opportunities. So, I was writing 10, 20 life groups, then, 30 to 50 life groups, 50 to 100 life groups. And then it just, the business started to spiral, and you kind of just learn step by step, brick by brick. And,
They all have
it's
different needs, right? At
really my career.
different sizes, right, Dan? They have different needs.
Yeah, yeah. So you're, in New Jersey, it's the 2 to 50 market. New York, it's the 0 to 100 market, right? And over the years, that business has changed, and it's gone through healthcare reform, and that was a challenge to the business. So learning that and how that business changed, and so yeah, they do have different needs, and we started doing PEO, which is the you know employee, leasing model, so to speak, professional employer organization. So we started, consulting on that business. So yeah, there's been a lot of changes in that smaller market. So, and had to learn it, had to learn each one of those pieces along the way. So I was appreciative to have stepped into that role and really learn. And yeah, and it's interesting when you're just on the healthcare side, you're working at Cigna, it's really just health insurance you're selling. And when you step over to the brokerage world, it was everything, right? So it was health, dental, vision, life, long, short-term disability. And each one of those products has its own unique challenges and rules and requirements. And so you really have to become an expert on all of those things, or at least be pretty knowledgeable in all of those
Right.
things, so you can consult a business owner.
Right. You're
And
trying to
so
build
so that
long-term relationships, right, with these companies, and you want to be their provider for a long period of time and adjust to any changes because obviously in the medical health area, there's all kinds of changes almost every seems like every year.
But yeah, I mean, it's interesting because it's driven a lot by not only local legislation but national legislation, and we saw that with the ACA when that passed, and the changes and the challenges that brought to employers and opportunities. The Affordable Care Act, interestingly enough, has not really made health insurance all that affordable, and most business owners have seen their costs go up over these last what is it now, close to 15 years that it's, maybe a little bit more than that, where it's been in play. And, it's challenging every year, and it's getting, more and more expensive. So, our goal is to, continue to scour the marketplace and find the best and most unique products that are available, and, bring those to the forefront. And we always got to constantly be doing that, and showing our employers what innovations are out there, because if we're not doing it, one of our competitors is doing it. So,
Yeah,
so
of
yeah.
course.
Yep. So so
So
Bru
Dan,
so
the size. Go ahead.
Bruce and I eventually, we were both working at inside Northwestern Mutual, and around the country, those groups were starting to, I guess maybe the owners of the different managing partners around the country were starting to see the values of health insurance, books of business, brokerage opportunities. They all own this separate business that was a health insurance and employee benefit brokerage, and there were starting to be some transitions around the country. And these blocks of business were either being sold off to your like One Digitals, your Gallaghers of the world. And Bruce and I had an opportunity to look at that. And so that's when we had an unfortunate way that we came across it. Our managing partner ended up passing away. Eric Olson was a good friend of mine, and we ultimately, Bruce and I, when that happened, decided that we wanted to, because we sort of built the business, we wanted to buy it. We didn't want to go work for a large, national firm at that time. I was young in my career. Bruce, I think, still had a lot of vigor in him as well, and he wanted to do it. So we ended up buying that strategic employee benefit services block of business, and renamed it Campbell Petrie. So it's really been the same company, just with different naming to it all of these years. We still have some of these same customers that, I started in 2007. We still have customers that were with us, back then. And to your point on long-term relationships, I think our commitment to, bringing more innovative products and staying ahead of the curve and what's being made available. And then obviously it's customer service as well. So we've built, an amazing team, both for our smaller businesses and our large group businesses, middle market companies.
That's great. Now you're running this now, Dan, because Bruce is now retired, right?
Yeah, Bruce hung him up this year actually. So he worked his tail off for, oh God, 40 years. He was in the business in different ways, shapes, or forms. And, and like many other people and, the people that you advise, he's, I believe over 70. I should know exactly how old he is, but, he worked, to his 70s, which is, I guess the retirement age, right? Was 65, but you're probably seeing it too in your business, right? Where, business owners and just people just have more energy, and they want to keep
They do.
working. That's
But,
that's
they want to talk about exiting, that Questar really specializes in both the wealth management for business owners as well as the exit process. And sometimes, it takes a while for them to figure out the exit strategy because what do they want to do after you sell your baby, right? Like this is a
Yep.
baby you've nurtured and grown. And probably like yourself, Dan, someday you're a pretty young guy. I know you hit the ball a long way, but I don't know if you want to golf 7 days a week. But the bottom line though is like you have to really figure out what do you want to do after an exit too. So just like
Yeah,
you,
that's
you're a business owner, but you're providing a service at the same time, and you want to see how long you want to do it. But I mean,
that's right.
so Dan, I know your firm stands out a bit because you really get into self insurance with these companies, right? So why don't you tell us a little bit about your sweet spot in the marketplace for number of employees? So if people want to contact you after this podcast and talk to you a little bit about self insurance and captives, I know you stand out in that market. So you know, if you want to tell us a little bit about that and then get into, a little bit about the beginning of captive insurance. What do people have to understand to really start the conversation with you as well?
Yeah, and it goes back to it actually could bring it back to the strategic employee benefit services conversation. When we left that model, one of the great things about it was, all the Northwestern Mutual offices, the benefits operations would share best practices with each other. And so when we bought Campbell Petrie, we sort of lost that, right? We were sort of out on our own here in New Jersey. We didn't have that bigger organization tying us all together. So one of our former partners who ran one of the offices down in Alabama, Scott Smith, got a bunch of us together and formed a group called the True Network of Advisors back in 2016. So that was really just getting, your best practices, your best products in the industry, vendor relationships sort of organized and putting us together in a room a couple times a year so that we could optimize our practices. And ultimately that's how I was introduced to Pareto, who is really our lead captive that we work with. They are the largest of their type. And I'll get a little bit more into detail about that, and it actually kind of trails into exit strategies. So that same group that was part of True Network, a group of us, 16 of us, were able to form an entity because everybody in our business is being bought out. I needed an exit strategy because I knew Bruce was going to be retiring at some point. I was going to have to buy him out, and we actually were foundational partners at a company called Patriot Growth Insurance Services. So we did take our exit back in 2019, and we're still running our P&L underneath the private equity holding and helping to grow that business that way. But that collective group, who is out now all part of Patriot, is also part of this group called the True Network of Advisors, and that's what we're doing. We're seeing what's the best available products that are in the marketplace. How do we make our clients' journey better with healthcare? And for us, we really embraced Pareto back in that day, and give them a ton of credit too for educating on us and what they do. And so the whole idea of the captive, right? And you look at it from two different worlds. You have the property and casualty side, um, where captive reinsurance or captive insurance on the property casualty side is really set up to pay insurance premiums into a bucket where you don't expect to have claims, or where you're managing that risk so well, um, that there's going to be reserves that are built up, and that you're going to be able to some point have a lump of cash sitting there for insurance premiums you normally would have transferred over to a carrier, but you're transferring them to an insurance bucket that you own yourself. So
Mhm.
Captives are insurance companies that are owned by, the folks that form them. Right. And so in the property casualty side, that's what you're trying to do. It's, hey, we're gonna manage our general liability, our workers' compensation, our auto policy, and we're gonna do some really good risk management. In our $1 million premium that we pay every single year, we're going to try to manage that to 200,000 in claims, and so there's an $800,000, just to use round numbers, reserve left over at every year. And if we do that for multiple years, we're going to put a lot of money aside by managing that risk. And that concept sort of taken over to the health insurance side, as we know that health insurance claims are they happen and they happen frequently. um, but the idea around the group health insurance cap is a little bit different. It's more about predictability and having a insurance policy that is probably too expensive to buy on your own, or maybe too risky to buy on your own. But because you're doing it in the group captive environment where you're spreading your risk across multiple employers and multiple employers that are doing the right things, which is very important, that people are actively trying to manage their healthcare claims and reduce costs and do all of the creative things that are available to employers. That's the group of people that you're joining in the captive. And you're also getting this really, really strong contract that sort of takes the risk out of self-funding, because that's why people don't do it, right? They think of self-funding as a risky strategy for health insurance, and it could have some really bad years. You could have really good years as well, but you can have some really bad years that could put you in a really tough spot from a cash flow perspective. So what the captive does, it absorbs that shock from year to year so that the volatility of your healthcare spend is pretty much capped at what you would be paying from a fully insured perspective. But you have all of the tools and resources that are available to you, that are available to very large employers that self-fund their plans. So now you can do all the things that are efficient around buying health insurance as a smaller employer that you would normally be able to do as, say, an employer with 500 to 2,000 employees.
What's the
Uh,
smallest size company, Dan, that really could look at a captive, and where's the sweet spot in that market?
Yeah, I'd say the smallest is around 25, and that's aggressively small, but it
Mhm.
does exist around the country where groups that small are entertaining these models. And they're probably more prepackaged models where you don't have as much flexibility, but you can get yourself into that self-insured world. Um, you know, Really our smallest clients are right around 50 insured. But I would say the sweet spot is probably, 75 to 250 employees, where you're starting to see your claims experience drive your healthcare renewal anyway.
Yeah.
And over 100 employees in the states that have a 100 ceiling for their small group market. So it's essentially that large group. And I would say, and you probably get some pushback, or I would probably get some pushback from some of the folks that work at the captives, because they are writing some larger entities into the captive, above 500, even into the 1,000 lives, because those entities want the, I would say, the stability of the captive and sort of putting their stop loss or their risk transfer on the shelf and not having to think about it. But that sweet spot is probably about 75 to 200, 250 employees.
So Dan, if in any given year I have a captive and all of a sudden I have several people get really ill that need a lot of costs and expense on healthcare, and I go over the amount that I've allotted, like kind of what happens in that scenario? Because I think people probably think of the worst case scenario, and I'm sure people like Cigna that you kind of compete with to some degree, right? Because I'm sure Cigna doesn't really embrace the captives, right? Because they're trying to sell theirs healthcare insurance, right? So like, what do you see as the downside risk that you can kind of make people feel a little bit more comfortable if, God forbid, they get a bunch of employees that get real ill?
Yeah, and I steal some of this language from my friends at Pareto. So when you're fully insured, right, you're really you're locking in a price, right, for a 12-month period of time, and it's guaranteed. And from now, so if I buy it in January, I'm going to be paying the same price. The only thing that's really going to fluctuate there is how many people are insured, right? And so at the end of the year, you're done, right? You've put that in the books. The problem is the renewal. So we can look at self-insured. I'm just going to use it as the lens to look at being in a captive versus being fully insured. So if you're fully insured and you have these same large claims, right, essentially all the insurance company is going to do is say, well, we took these losses on you in this year, right? We gave you X price last year, but in order for us to make up for that loss that we took last year and what your claims are going to be next year, we need to increase your premium to X, right? And then the problem is with fully insured is you're guaranteed to have to pay that premium, right? So the following year, if those big claims, and that's and we see that with big claims, and it's unfortunate in some cases, right? Because people pass away, or they're episodic events like an open heart surgery where it's $400,000 or $500,000 claim, but it was an open heart surgery, the person survived, and then the following year they don't have any claims,
That's right.
right? But in fully insured, you're going to have to pay for that loss that you took in the prior year, and you don't have that chance for the bounce back year. So what the captive really does is, you know, two things to protect you from the large claims. One is you get a rate cap, and because you're buying this policy, this stop loss policy with a group of employers, I think Pareto now is somewhere around 3,500 employers around the country that have embraced this model. You're spreading your big claim, your bad claim years over those 3,500 employers, right? So which is normal, like the fully insured books, they have a pool, a book of business. But what is the 3,500 employers that have joined Pareto, they're actively managing their claims. So they're going to get a better outcome than the open market, right? It's a
Are you
better.
sharing the risk though, Dan, if you join Pareto with all the 3,500 companies?
You are. So for that, the things that you get for sharing a risk, one is you get this 30% rate cap on your stop loss premiums, right? So your stop loss premiums, they make up about 30% of your overall budget. And so in your worst case scenario, your 30% of your budget can go up by 30%. So, somewhere around a 9% budgetary increase from year to year. So you have some predictability around that.
Do you
The
want to
other
explain
thing,
exactly what that stop loss is, by the way? That
yeah,
term?
so stop loss, so there's two types of stop loss. There's the individual stop loss contract, right? Your individual stop loss is for your very large claims on a single person, right? So if a person on your policy runs up, $2 million of claims, and that's one of the things that's driving healthcare now. We're seeing a lot more of those $1 million, $2 million, $5 million health insurance claims that do exist. If a person has one of those claims, you as the employer, your responsibility is up to your individual stop loss limit. So, for a group of say 100 employees, their individual stop loss limit might be something like $75,000. So there's a $2 million claim out there. The money you pay towards that claim is $75,000, and that's it. So you're capped there. And that $75,000 that you spend, that goes to your, small claims bucket. And you also have a cap on that small claims bucket. These are all of your dollars that are below your individual stop loss limit. And that adds up to be your annual maximum liability. So making it very similar to fully insured, where that if you get to a certain point, you have an aggregate insurance policy that will cap you, which is, making the model very similar to fully insured. You have a known risk for a 12-month period of time. And typically it's a little bit more risky than you're fully insured. It's going to be a little bit more expensive that in your first year. But as you go over time, you stretch this out and you realize that you have bad years and you have good years. When you can take advantage of those years where your health insurance claims dip, that's really where our employers beat, the market, because they could have a year where they were facing a 30 or 40% increase in their health insurance costs on fully insured because of the bad claims they had in the prior year. And they come out the following year and those claims fall off the books and they run at 50% loss ratio, and 50% of their budget they were anticipating spending, they keep, right? They don't have to spend those dollars. So that's, when we look at it over a multi-year period of time, and that's really what we're stressing to our employers is that, you're going to be buying health insurance foreseeably for the next however long you're in business, right? So we look at these things in 5 and 10 year windows and say, listen, if we do this efficiently over the next 5 to 10 years, what are you going to be left over with, right? As opposed to if you've got an average increase, and an average increase in health insurance historically has been somewhere around 9%. It's a lot higher than that this year. I think any business owner that has looked at their insurance renewal this year, they would have been happy with 9%. We're seeing closer to 17 to 20% across our
Really?
book of business this year.
Wow.
And it's because of the big claims that are out there. But but what we're seeing is that, obviously healthcare costs is escalating. But if you look at the fully insured market and you wrote out that 9% compounded versus being able to take advantage of the fluctuations and the efficiencies of self-funding, you can beat that. You can beat that 9% by, 3 to 5%. And when we look at that over 5 to 10 years on millions of dollars of health insurance expenses, it can be a tremendous bucket of money. And so that's really what we're it's the difference between the property casualty conversation where you're trying to get those reserves, build up the reserves, and health insurance, you're just trying to beat the open market by 3 to 5% on across a very large spend, and those dollars will add up to you. And there's a lot that you can do to
Yeah.
create that 3 to 5%, which is what I think our value is teaching the employer all of these efficiencies that you can achieve by being self-insured versus, being fully insured. And it's the profit centers. It's the profit centers of the fully insured carrier that now become the employer's profit centers versus the insurance company taking those profits.
Interesting. I wonder how many companies don't even know about captive insurance, or they just kind of, their broker really doesn't explain it and they don't have it as an option. But I'm sure it's becoming more and more prevalent in the marketplace. Dan, is there
It
is
is.
there a real
Yeah,
world
we
is
have a
there a
lot
real
more
world
competition
example?
now.
Yeah, is there a real world example of a client of yours that benefited from joining the captive or forming a captive that you could talk about?
Yeah, I mean, without talking about the particular customer, it's interesting that the CFO of this company left the company that we did this at originally, and now is the CFO of another company, and we're working with that company now because obviously he was pretty impressed with the results that we had. And it comes down to, really taking a little bit of risk and understanding your data a little bit. So this particular company was actually probably the third customer that we had moved into the captive. And I would say it was probably one of our best results that we ever achieved in the first year. And this group was facing around a 40% increase on their health insurance costs. They had a little bit of claims experience because they were over 100 employees. They didn't have a great ton of detail. You do get some idea of what is going on, what is actually driving the health insurance spend. So we had a little bit of inside baseball on that.
Hmm.
And when we were negotiating their renewal with the fully insured carrier at the time, we were trying to present that idea to them that, hey, we believe that this person is going to be coming off the policy, in the first quarter of the year. So we understand that this large claim, we understand it's driving a big portion of the increase, but can we get a little bit of relief on that because of,
Hmm.
the inside baseball knowledge we had? And they, really were pushing back on us. They had taken a big loss on this claimant in the prior year, and they needed, and the rest of the fully insured market wasn't really reacting at all. So we didn't really have a good price point to move them to another carrier. And so we brought the captive conversation to the table. And on paper, it actually looked worse, like significantly worse than the fully insured renewal. I think they were looking at somewhere around $300,000 of excess over the fully insured renewal. But what we knew is that we had a lot of upside with this person coming off. And so it was sort of like all the stars aligned for this client in that one
Huh.
year. So we were right. That person came off the policy. They actually came off in that first month. So, basically took $300,000 of potential claims right out of the gate off the table, right? Which basically ate up most of their increase. And on top of that, the rest of the plan ran really well that coming year. So they took going into the fully insured policy, they took about a $3 million potential liability. And in that first year, they ended up spending $1.5 million over 12 months. So right out of
Right.
the gate, and their fully insured renewal was somewhere around $2.7 million. So instead of guaranteed to pay the 2.7 million, they ended up spending 1.5, and we put $1.2 million back in that employer's pocket by guiding them towards, making that change. And again, like they've had bad years since then, but I've been working with that group and I still work with that company. That company has not increased their health insurance contributions or changed benefits since 2016.
Wow.
So
What type of
con-
company is that, Dan? And how many employees do they have?
at the time, they were about 130. They're up to about 270 employees right now. They're in marketing
Wow.
and on the pharmaceutical side. So they have some inside baseball on the cost of pharmaceuticals as well.
They sure do.
But yeah, but again, we've been working them for they're a New Jersey based company. They have people all over the country. But they've, like I said, their health insurance costs have stayed pretty steady for close to 9 years now, and we see that with most of our customers. Where when they've entered this model out of fully insured, from where they started to where they are today, it's a trend that's closer to 3 to 5% versus that 9% that you're seeing in the fully insured market. And so when we compound that over 8 to 9 years, I mean, just being a financial advisor, making 5% on something,
Rich.
over a 10-year period of time on a couple $1 million is, it's real money. And that's the thing. You got to get the employer to embrace this as, we're going to be buying health insurance for the next 10 years. So let's put a plan in place that can help us, you know,
Yeah,
look at
that
that
makes sense.
that big bucket of money, and let's manage the 10-year spend versus managing the 12-month spend.
Right. And I think that putting together the long-term chart for you on what their costs could look like over a 5 to 10 year time frame is probably the sales pitch to get the company to make a move. Right.
It is, and it's a thing that they have. It's changing their mindset, right? Because they've never thought about health insurance. Most people that sit in my chair as an employee benefit broker, and I would say that's shifting, right? I would say it might not be most anymore. I think a lot of us have spent a ton of time learning about this stuff. There's a lot of great, competition out there, and a lot of smart people that I share things with, and they share with me, and it's a good community of us. I'd say that are on the right side of the fight. And so I would say where I say most people in my chair are doing this, I think it's getting closer to most are starting to learn this model and bring it to their customers, which is a good thing, I think, for everybody involved in the industry. But yeah, there was a 10-year period of time there where, when I had this conversation to them, people sort of looked at me like I was crazy. Like, why would I go self-funded? I'm 70 employees. We're way too small for that. And then a lot of these sales cycles, where we get them to become our customer, are 1 to 2 year pitches, and we see that the client has a moment of frustration where they get a big increase from a carrier. They're not getting any information around why their health insurance is going up. They have no data, to back up why the increase is there, and I think people just get to a moment of frustration, and they need to turn to somebody like us who's willing to roll up our sleeves with them a little bit and do the hard work to get your health insurance costs in line.
So Dan, real life is that if someone gets referred to you, they're going to kind of tell you, hey, this is what we do with Aetna today. Here's our costs. Here's what's covered. Do you do like a 2 track for them and say, hey, look, we're going to show you like a what if scenario if you look at self-insurance or a captive versus your current plan and kind of show you over a 5 or 10 year period of what it might look like? Is that kind of the process you take clients through?
Yeah, yeah. So from our side, that's exactly that. And for the most part, we're not changing benefits. We're not changing contributions to the employees. So those things are sort of like, we put those on the side. Uh, we partner with independent third party administrators, and we rent the big network. So we'll give them access to a Blue Cross, a United, Cigna, or an Aetna. So they have a group of doctors. We use an independent third party administrator, or excuse me, prescription benefit manager, that does a tremendous job. It's actually one of the biggest opportunities for savings for employers is the prescription side. We see, the advertisements, daily for the GLP-1 situation that's going on in the
Yep.
country. Some of the infusion and cancer therapies that are out there that are, $500,000 to $1 million a year. Like there's a huge opportunity for our employers just to save money on that. But yeah, so we will sit with the client, we'll look at and say, hey, listen, with us over the next 12 months, in a worst case scenario, this is what it looks like. And then we show them, here is an average outcome. Like this is, if you just had a pretty good year, this is where you will be. If you had a fantastic year, this is what you will look like. And that's your 12-month snapshot. We actually give them a cash flow diagram too, because one of the benefits of self-insurance is cash flow, right? You're paying for things as
Yeah.
they happen. You're not prepaying for them. So we show them the cash flow. And then we take those numbers and we kind of look at those scenarios, your good, bad, and ugly, over the next 5 years, and where we're going to end up. And it's, for the most part, it's evident to most employers that, it's a better model. Some groups aren't ready to make the jump. They may not feel that they have the administrative, help in the office to go through the process, because it is a little bit more work for employers. I wouldn't say it's a ton more work, but getting it set up and understanding in that educational process is. But once you get up and running, it feels very much like the insurance policy you're taking today. And the vice versa that. So my partners, at Patriot, which is our larger company now, that do this on the property casualty side, they do it in reverse, right? So they actually, because all property casualty comes with loss runs,
Yep.
they look at their last 5 years and said, hey, listen, if you were in this structure based on your losses on the last 5 years, this is how much cash you would be sitting with today. And that's actually, when those go well, you get a lot of employers that are kind of kicking themselves in the ass a little bit, like, oh my God,
Yeah.
like how much
Well, the
money
thing
did
is,
I leave
this
on
this
how
is
much
like
money did I leave on the table over the last 5 years?
yeah.
Yeah.
Well, when we do valuations of companies to exit, and we do valuations on what is an ESOP sale versus a private equity sale to strategic. If this is an add back like health insurance premiums, this would dramatically increase their EBITDA, which would dramatically increase a valuation of 10 times EBITDA, right? Like you're looking at a dramatic increase. Like your prior example of the marketing company in the pharma business. I mean, that addition to EBITDA is
Yeah, if they
incredible.
exited that year, they had 1.5 million of extra cash, times whatever multiple you get in that space.
That's amazing.
If
It
it's
really is. I
10x,
mean,
it's $15 million,
I'm actually
you know?
amazed not more people do the captive. I think that people are scared of the captive because of like that one person that might have a huge claim, and if they're gonna have to write a check, and like what's the risk, and they don't probably look at the long-term effects. It's almost like in the stock market, everybody's worried about a one time 1 year major downturn in the market, but the rebound and the market performance over 10 years is what you really need to look at, and probably the same with captives.
It's the same. It's the same. It's the long game, right? Like you're going to be, as an investor, right? You're going to be, money's going to be coming out of your paycheck going into your 401k every cycle now for the next 20 years, hopefully that you're employed. And, if you just consistently do that, you're going to take some losses, but, generally speaking, over the course of time, it's going to go up at that, 10% rate on the S&P. And then you look at health insurance, right? If you remain in the model that you're in today, it's sort of the inverse of that. Your health insurance costs are going to go up by 10% if you don't change the way you're doing it today. But if you take a different investment strategy that's going to beat the market, so to speak, by 3 to 5% every year, you would probably want to do that.
Yeah. Are there any trends that you see right now in captives, like types of companies that are doing this, or is there any trends that you're seeing right now?
I think it's Pareto's a heterogeneous captive, right? So all types of employers are in it. I think there's a couple NFL teams that are in it now. I mean, like for
Really?
instance, yeah, yeah. So you have some professional sports teams in it. We have a bunch of nonprofits here. We represent a lot of the ARCs in New Jersey, and you know, for me, that's been helpful because being a nonprofit, like we've saved them a lot of money, right? That's going back to helping people. So, um, you know, there's that EBITDA conversation for a private company where you're increasing their value, but for me, like I really like the nonprofit side because nonprofits are typically scared to go self-funded, right? Because they rely a lot of, whether it's state grants or donations from
Yeah.
folks and funding from sources, and they have a finite budget. And so if we can put an impact into that finite budget over a course of time, it just helps them help more people. So there's that nice part to it as well. Um, but yeah, I mean, when we had gotten together and we talked about how does this fit into an exit strategy. There's obviously the value creation there where you're running your health insurance better. So your company's going to be more profitable, or on the PNC side, you're managing your risk better. So you're going to be more profitable as a company. But I also think it does show, um, I think it does show the fact that you as a company, that you've made this bold decision and you're actively managing your risk, and you've put guardrails in place to control costs. I think that increases your value as a company as well, right? Because you are a business owner that shows discipline, shows awareness, and that, I guess, mantra that you're taking to your insurance programs, it probably trickles over to the other parts of your business as well.
Yeah. So, Dan, if I'm a business owner or CFO curious about captives, what's the first question that they should ask themselves to get into this?
Yeah, I mean, well, I think every one of them gets this question every year, right? Are you happy with the financial burden that you have with your insurance costs right now, right? I mean, if you're interested in a way to more efficiently purchase health insurance and keep your risk profile the same, is that something you're interested in? And it's few and far between. We find business owners that once they spend 45 minutes with us, that they're like, this has to, this is a better way, right? This is definitely a better way. I don't know if we're ready for it, but I can clearly see that this is a better way to buy my health insurance. Our pushbacks are typically product knowledge, administrative burden, um, timing in their cycle, right? If they're too close to their renewal, they're not ready to make a big change. A lot of those groups will stay in contact with us over the course of the year, and we get a jump start on it for the following year. But it's few and far between that we sit with somebody that says, this is not right for me.
Yeah. And I would think you get a lot of referrals from existing clients.
We do, and it's one of the nice things about being part of a captive. Pareto, like as I mentioned, is our lead, right now, and they've created a really great community of their membership where they spend time together so that the business owners, your financial people, your human resources people, they travel together once or twice a year to be educated on what's going on in the space, how they could better run their plans and get best practices from those other entities, and sort of gets the insurance people like us out of the room for a little bit,
Yeah.
and allows, other businesses to collaborate. And that's actually one of the most powerful things that the captive offers is that closed group of people that are sort of, you're in the same canoe together, right? You're on this, you're in this insurance platform together, and the better everybody operates with inside of that, it's a benefit to everybody else as well too. So the openness and the sharing amongst employers is one of the best things that the captive promotes.
You need to create a captive for retired people because retired people, that's like the number one when you talk to people about retirement is their healthcare costs post when they leave their company and they're on their own. Everybody's trying to navigate through what makes the most sense for them and their family and figuring all that out, but they need they need a way.
I
And
think the
usually
federal
so
government has a
uh,
captive called Medicare for
yeah, well
the
that's
folks.
that's true.
Yeah, and honestly, I would think that's a tough challenge in and of itself. But yeah, there really is a because of the early retirement now, there is a problem from that. I would say 50 to 65, where it's tough to
That's
get a
right.
good health insurance policy.
That's
But
true.
it's also that period of time where most people are spending the most money on health insurance from age 50 to, whenever they pass away. That's where all the money is spent. So it's a difficult risk to undertake, and it's a challenge for the country, for sure.
Yeah. Well, Dan, this has been great. I can see you're excited about it and excited about keeping growing your business. And how do people find out a little bit more about Campbell Petrie, your website?
Yeah, you can go to campbellpetrie.com, and spoiler alert, that will probably be changing to Patriot. We've been involved with Patriot since 2019. Now the 24th largest broker in the country, which is fantastic. And we've grown our business successfully, not only on the employee benefit side, which was our foundation, but now we're about 50-50 mix between property casualty and employee benefits. And so, look for that change to, Patriot in the coming year. But, for now, it's, just Daniel at campbellpetrie.com. Feel free to reach out. And you can check our website out. But yeah, we'd love to, have a conversation with, any employer that's looking to start playing offense and stop playing defense, right? Because if we can take it where we're aggressively attacking the problem and that is your larger claims, your pharmaceutical situations, and we can aggressively attack those problems. We can no doubt beat the trend of the fully insured marketplace.
That sounds great. On a less serious note, Dan, I mean, your golf swing. I mean, how do you hit that ball 300 yards? Now, I've witnessed it firsthand. Is there any advice for those that want to hit the ball a little longer?
Do do yoga.
Okay, yoga. Okay, yoga. It sounds like a good answer.
Yeah, I no, I'm lucky enough to have, I played college football, right? So I have the strength component there, but I think, playing baseball, hockey, all the other sort of hand-eye sports have, helped connect, 240 pounds and, 6'3" with some decent hand-eye coordination.
There you go.
But I also give my testament to, a period of time that not everybody loved, but I sort of loved it for golf because when the world shut down in 2020 and the only thing you could do for 6 months was play golf, I played more golf than I can. Almost made me sick of it. But it is certainly a rep sport. So if you get out there and you do anything for what is it, 10,000 hours? I think I got all 10,000 hours during COVID, so that was very helpful.
Awesome. So Dan, on a drinking note, I know you like to have a cocktail or two. I've been with you. And what is your favorite bourbon? And I know you are a fan of bourbons, correct?
I like bourbons. It's that time of year. I transition from maybe vodka or tequila in the summer, and then
Mhm.
this time of year a little bit more red wine and bourbon. Um, I'm gonna give a shout out to my buddy over at Penelope Bourbon, Mike Palladini. I've been drinking a lot of his stuff. He's a local New Jersey guy, and he started his own bourbon brand a few years back. So
Really? That's
I'll
great.
say Penelope is my favorite.
All right. And that's sold locally in New Jersey?
Yeah, it's sold all over the place. And then if I had to go outside of that, I'd say I like Blanton's. I like Whistle Pig. I like there's a bunch of them out there.
All right, good. I've offered to
Buffalo Trace.
no, can't go wrong there. I offered to do the chocolate old fashions for the holidays this year. So I'll be making those at Christmas time. So I
Oh, there you go.
found a good recipe for that.
You can do the espresso martinis with the bourbons too.
That's a little known fact. That's a good call, Dan, because I've taught many people it's like you don't need vodka, you could do bourbon and
That's right. That's right.
espresso martini. Well, Dan, thanks for your time. I really appreciate it. Happy holidays to you and your family, and I really appreciate your time today.
Thanks, Jerry. I really appreciate it as well. And happy holidays to you guys as well.
Awesome.